We got Redbook numbers out yesterday. I got a chart on this one. I don't know if I trust these numbers. I mean, I trust that yesterday we saw a deceleration to 3.6% positive from 4.6 a week prior. The 2-year average slowed by about 900 basis points. No, I'm sorry, 90 beeps. God, that's a big difference. To 7.1 from 8.0, but they spiked a couple of weeks ago, and that's just inconsistent with what we're seeing with traffic and with retail sales. I trust these traffic numbers a lot better. And if you go to the next slide, guys, you can see that traffic still looks really bad. And this is in line with what Howard was saying about restaurant sales. We're seeing the same thing at retail overall. Overall, we saw the 5-week trend, which is what I really care about, decelerate to down 4.9 from down 4.3. The call there is to short the XRT. We haven't even seen the impact yet of student loan hits and cuts in spending from student loans. Maybe we've started to see as people are planning for it, but I doubt it. People aren't going to stop spending until the cash isn't in their account. A couple of subcategories and stock calls I want to touch on. One is beauty. You can see on this next slide here, this is like the impenetrable category. It's been strong for like 3 years straight. It's been incredibly strong, and it slowed again both the past week and also on the 5-week trend. The calls there, you want to short Ulta, ULTA, and Sally Beauty, SBG. Sally Beauty especially is like the Payless or the Radio Shack of beauty, and we know those stories didn't end well. Next one is home improvement. We saw a deceleration there too. We're short Lowe's, LOW, Home Depot, HD, and Floor & Decor, FND, in that order. Lowe's is our favorite short there. We're seeing a deceleration there. And then lastly, saw just a huge deceleration over the past week in consumer electronics stores. We're still short Best Buy. This is a name where optically it looks cheap, but this company's got 4% operating margins. It's got credit risk in the back half of this year with its credit portfolio, and a whole host of other issues, and sales are decelerating, and we haven't even seen the hit from student loans yet. So I think you have risk to the quarter on that one and just risk to numbers overall. When you're a company like an RH that has operating margins of 20 and you give up 2 points of margin, it's like, all right, who cares? EPS numbers hardly move. But if you're a 4% margin company and you lose 200 basis points of margin, your earnings get cut in half and the stock goes with it. So we're short Best Buy, and this data point, it certainly supports that.
So many of these, including the XRT, are just great examples of being a full cycle investor, right? I mean, I can beat myself up in public because people like it all I want, but the fact of the matter is that these stocks put in big time lower highs in January, really struggled to get back there, and have just been dogs. It's like, when I'm beating myself up, I'm more like talking about the NASDAQ or, some GDP misses that we had on the numbers, which is going to happen. But, you staying with your shorts has been nothing short of world class, man. And these things, including the XRT itself, are just dead. And we'll just keep updating people on that. You can make a lot more money if you stay with something using the risk ranges, fading market moves, and all the emotion embedded therein if you just stay with the full investing cycle.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.